Joining us now to discuss is Stuart Kaiser. He is the head of equity derivatives research over at UBS. Stuart, great to talk with you. Once again, let's just start with what we've seen in the last couple of weeks and this rotation trade, the return of volatility into the market, but vol that's come back in as the Dow is making a record high. Obviously, the Nasdaq is off its highs, but we haven't seen the kind of sell-off perhaps that may have been anticipated with the VIX kind of creeping back towards 30.
Yeah, definitely. It's definitely been an interesting couple of weeks. I think, as you highlighted, one of the big takeaways has been, below the surface, there's been what you would call a pretty aggressive rotation. And that has honestly just kept the index relatively well supported because there's not money coming out. It's just sort of money moving itself around. So you've had energy and capital goods and banks and materials and the more cyclical parts of the market, posting positive returns, and obviously tech under more than a fair bit of pressure, and that's resulted in, I think a painful trade for active managers. But if you're just an index person, it hasn't been that painful, just because that rotation has kept things sort of sideways, I guess.
Stuart, bring us into the nitty-gritty in the markets the past few days. Why is the market starting to look past what's happening in the 10-year? Really, we're back in rally mode, and a couple days ago we weren't even in this situation.
Yeah, well, I mean, our view kind of medium term is that yields are moving higher for the right reasons. And that's, increased expectations for both real economic growth and inflation. And typically that's actually pretty supportive of equity markets. I think what was disruptive is it happened so fast. A lot of folks expected this move to kind of happen over the course of the year, and instead it happened in, about 4 weeks. So, to me, that's what was much more disruptive, was the speed of the move than the actual move itself. And clearly it got people very worried about leadership in the market, and tech in particular being negatively impacted by the rise in yields. Our view is that that's not necessarily the case. Over the last couple of years, actually, Nasdaq has had a positive exposure to rising yields. So, again, we think it's the pace, not the direction. And I think what's happening here, to your point, is yields have actually gotten to a level where they're starting to get fairish, I think, based on what the outlook is for the economy. And for that reason, I think people are, I guess, comfortable to step back into some of these large cap tech stocks that they've frankly been in love with for the last 12 to 24 months.
And Stuart, and we're just going to pause here for the opening bell, because today it's Coupang, which is basically South Korea's answer to Amazon. They're having their initial public offering today, 130 million shares at 35 apiece. They raised just over $4.5 billion and giving the company a market value of about $60 billion. This is one of the biggest listings of the year here. So we'll see what that demand looks like. We saw a big debut for the direct listing of Roblox yesterday. We'll see if that demand continues for Coupang today as we track that company when it starts trading. Stuart, while we're looking at something like that, a topic like an IPO, obviously we've seen a lot of this sort of what I coined earlier in the year as thirsty cash going into IPOs and SPACs and direct listings and meme stocks for that matter, and crypto. How have all of those dynamics been affected as we have seen the recent volatility in the market?
Yeah, I think you make a great point. There's a lot of cash to be invested, and frankly, if you believe the economic growth forecasts, you want to be in risk on mode. And I think for that reason, people are putting in money into the markets and are willing to take maybe an additional bit of risk on something like crypto or an IPO or a SPAC. So, I think it's healthy that money is on the sidelines and is willing to come into the markets and do it in a relatively, I guess you might call, high risk way. Those trades, as you mentioned, though, are, they are volatile. So when you do get pullbacks in risk sentiment, those are the ones that tend to come under the most pressure. So as long as people are prepared for that, I think it's a healthy thing. But, from my perspective, I don't understand the SPACs, all that well. But what I would say is it's a way for companies to go public and access public markets for cash, and investors are willing to put cash in those stocks. And to me, that's a healthy functioning of capital markets, and I think we should read that as a positive.
Stuart, as I mentioned before the break, you were with us 1 year ago today. You and I were sitting across a desk from each other in person, and I want to play for the viewers a little bit of what you said that day.
In the U.S. markets, frankly, things just still look very troubling to us. With 10-year yields where they are at such a low level, that sends a very bad growth signal to the markets. The amount of volatility in gold, the Japanese yen, and the U.S. 10-year Treasury, which are your typical safe havens, is just very, very high. We think that's a risk indicator for equity markets. And to your point, even on good days, implied volatility doesn't come down very much. And I think that's the market sending you a message about how long this could persist.
So it's pretty incredible looking at that 4% drop there in the Dow to 24,000. And here we are on the Dow today, above 32,000. And volatility did persist. It didn't persist quite as long as probably anybody thought it would, Stuart. So I'm curious, looking back on that and the sort of lessons you learned from that period, what does that tell you about the tea leaves that you're reading right now?
Well, thanks for playing that. Actually, I'm happy I didn't say anything too stupid. I guess what I would say is it's funny we're still talking about rates. Now we're just talking about rates in the opposite direction. And to your point, vol maybe didn't persist as long as we might have expected, and that has a lot to do, I think, with central bank intervention, and particularly them being willing, to enter into the credit market. So, we certainly, I think, learned about, the Fed's appetite or willingness to kind of step in and support risk assets if they have to, and that clearly was a big driver of things. What's interesting now, though, is if you look at that medium-term volatility pricing, it's at similar, if not higher levels today as it was back then. So even though, a lot has happened, markets have rallied and healed, there is still, I think from the institutional investor community, a little bit of caution in terms of how this is all going to play out. Back then it was, how is the bad news going to play out? I think now it's more, how is the good news going to play out? Is the move in growth that we've seen and the amount of stimulus in the system going to push rates to a level that are an issue, going to drive inflation to an issue, to a level that's an issue? And then as we get into the second half of the year, is this going to embolden the tax and regulatory policy or China trade negotiations that in the past have become disruptive to the market? So I think we definitely learned a lot about the impact of policymakers on the markets. And it's just funny today that, exactly what we were hoping for back then, which was nominal growth, we've gotten, and now we're worried about that. So I guess it's taught us that the markets are going to be worried regardless, and we should just embrace it.
And certainly a different conversation at S&P 2500 than S&P 4000, which we're closing in on now. All right, Stuart Kaiser with UBS. Stuart, always appreciate your time. I know we'll talk soon.